In this video today, we're going to discuss how to trade the ES options on futures for an account less than 25K. The reason we're going to discuss this because there's a lot of people out there that do not know that you can day trade the ES options just like you day trade the SPX options. Can you look at the camera when you do that, please?
No! Happy trading! And please subscribe to our channel.
The SPX options are cash settled each day, and it's a very, very popular type of strategy that people are using. But to be successful at trading the SPX options, especially in this current market environment, you have to be able to adjust. You have to be able to adjust even if you have a stop loss type of process, the way we teach in the Dorian Way statistical day trading course. We'll put a link in the bottom about that. When you are day trading options in this environment, it has been some huge intraday type of moves that will cause you to be stopped out if you're using a stop loss type of process. Or if you're not, if you're using a manual type of adjustment, you're going to have to adjust in these markets, or you're going to have some losses. So if you do not have an account that's 25K or more, ideally more, then you shouldn't be trading SPX options for day trading, because it's just going to be super difficult to make any consistent monies. But if you have a smaller account and you want to kind of supercharge your trading, to accelerate your learning process and to potentially increase your gains significantly, then you should consider trading in the ES options on futures. The ES options on futures do not have to worry about the day trading pattern rule because they are regulated by a different regulator than the SPX. The SPX is regulated by the SEC, which we have all heard of. They regulate all kind of stock options and securities. But the Commodities Futures Trading Commission, they regulate everything in the futures market, right? Everything that has a kind of a forward slash, as you can see on our screen here, everything that has a forward slash. ES options is exactly like the SPX options. It's associated with the S&P 500. If I bring that SPX up again, you'll see that this is the S&P 500 options. The only difference with the ES options is that the ES is half the size of the SPX. Okay? That's the only difference. If the SPX is going up 1%, the ES is going up 1%. And if it's going down 1%, they're both going down 1%. Okay? It's exactly the same thing. And I can argue, and a lot of us at the Dorian Way can argue, that the ES is the more important index to watch, right? Because it's trading more around the clock, right? It's the futures that's trading almost every day around the clock. And the SPX is not. It's only trading during regular trading hours. But some people say, well, the SPX is cash settled. Well, that's one of the great things about the SPX. It is cash settled. If you have something that's in the money at expiration, it's just going to be cash settled. The ES is very, very close to that. You do not have to worry about being assigned a futures contract unless it expires in the money, right? And it has to expire in the money. Even if it's 1 minute before expiration and you're in the money, you do not have to worry about being assigned unless it expires in the money. Okay? So it's almost cash settled. And then the ES options for quarterly options are cash settled. Okay? So, but another big difference is that the ES is half the size of the SPX. So the SPX is $100 per point, and the ES is $50 per point. So it's half the size, and it's half the size. Now, when we are trading the ES at the Dorian Way for individuals that have small accounts, or even if you have a bigger account, we set it up in this nature, and you can learn more about this if you decide to join the Dorian Way, or if you come to some of our webinars that we have at least once a month on day trading options. You can learn that kind of our process of it. You can also learn our process by going through our statistical day trading course. We'll have the link in below. So, but we have a process of how we trade short-term trades. So at the Dorian Way, we look to see what is the rule of 16 for the VIX, right? So we divide the number that the cash VIX is currently trading at by 16 to be able to get that daily expected percentage move, right? So The rule of 16 is giving you what is the expected percentage move, up or down. And it's only for one day. So you can't use this for something that's past one day, 30 days, 60 days, a year out. You can't use it for that. But we take that information and see what the VIX is expecting the percentage move to be, and then we look at the expected move on TastyWorks or Thinkorswim on the options chain or Interactive Brokers, whichever platform you're on that specialize in options. You should be able to have an expected move there. We take that expected move. Then we also look at the straddle expected move, the straddle price expected move. This is kind of like the back of the envelope type of way to understand the expected move, especially if you're on a platform that doesn't give you this expected move. So the expected move here for the straddle price is $19. And that's very close to what TastyWorks is indicating here, which is about $17. TastyWorks believes their formula is better and is more closer to a one standard deviation type of move. But at the Dorian Way, we want to use the bigger amount, right? So 19 is the expected move. So usually we want to be 2 times the expected move or more, ideally. If we have to be closer than that, then usually we're not setting up anything closer than 1.5 times the expected move, because we want to have the wiggle room to be able to be wrong with the trade. And at the Dorian Way, we usually are trying to collect at least $1 on the short leg. So if we were going to set up this trade here, we would put it here at the 11 delta here, because this is the last $1 amount. You can see below here, this is not a dollar amount here. So this is a 10-point wide spread we set up here. And then we'll do the same kind of concept on the put side here. We're going to do a 10-point wide spread, and you can see that before fees and commissions, you're collecting about $60 here for this trade. And as you can see, it's not 120 because the ES is half the size of the SPX, as we indicated. Now, when you are setting this trade up, we encourage members to set it up as an iron condor almost 100% of the time. Nothing's 100% of the time, but you don't want to try to predict which way the market's going to go. You don't want to say, okay, I'm just going to put the put side on because I believe the market is going up, or I want to put the call side on because I believe the market's going down. You do not know which direction the market's going to be going, so it's better to put on an iron condor, because an iron condor is inherently neutral. And so you're not trying to predict the direction. You're just trying to structure the trade in a way that gives you the best wiggle room possible. And at the Dorian Way, we believe that when you initiate the trade, that's the only time you can control everything. That's the only time when you're on offense. So you want to make sure you have solid criteria to be able to place the trade in the best probabilistic way possible, so that you can have a super high probability of winning. And because once you put the trade on, then you are on defense. The market is controlling what happens next, when you're going to have to adjust, when your stop loss is going to be hit, things like that. So you want to make sure you have solid criteria. We teach that here at the Dorian Way. All right, so when you're doing these trades, you can decide to do a 10-point wide. You can decide to do a 20-point wide. As you can see here, this is a 20-point wide spread now, and this is changing the amount that you're going to receive. So instead of $60, you're now getting $85. And we usually try to put on these trades anytime within 2 hours of the market open. For me personally, I like to put on the trade within 30 minutes of the market open. Right now, the market has basically been open for almost 2 hours, and you can see that you can still put on a solid trade here. So that was a 20-point wide spread. If you did a 50-point wide, it looks something similar to this, and we'll put the 50-point down here. So we usually encourage members to do anything from a 10 to a 50. Some of our members do 100. Dr. Metal sometimes is doing more than 100 wide spread, but most of the time it's around this 50-point wide spread or less. Okay, so you can see here that now you're getting $100 for this, and you have a 50-point wide spread. You're getting more capital, but you also get a bigger potential max loss, which is just under 2,400 here. So you have to decide how wide you want the spread. It's better to have a tighter spread initially until you understand the process of this trade, until you understand all the ins and outs, the cadence of this trade, so that you can avoid big losses. If you're going to use a stop loss, you have to learn how to use that stop loss. If you're going to adjust manually, you have to learn how to adjust manually correctly. And we teach that. We teach both of those at the Dorian Way. All right, so this is the type of trade that we would set up, and then we would monitor it based on if we're manually going to adjust or take off, or if we're going to do it by an automatic type of stop loss or takeoff process. So if you're interested in learning, please consider joining the Dorian Way. We thank you for watching this video, and we'll see you in the next video.